Well, Lyn, thank you so much for joining me. How are you liking Oslo?
Oh, it's amazing here.
It's your first time, right?
Yes.
How do you find the conference? This is a little bit different, I feel like, than some of the other ones we've been to, Bitcoin Miami. Doesn't just have Bitcoiners, right?
Yeah, I mean, it's mostly human rights, and it just, the fact that Bitcoin's here is mostly focusing on a human rights angle, right? So how to help the people that are most, most needing of it, right? So a theme I've had is that basically, as useful as Bitcoin is to me in a developed country, it's kind of optional, at least at the current time. Whereas for a lot of people, it actually can change their life in ways that, for me, it's more like an investment or more like, an asset compared to other assets. Whereas for them, it's, having, cryptographic money, Bitcoin, censorship-resistant value that they can change peer-to-peer, that they can move with them, that's hard to, confiscate, that's hard to block in any way, changes everything.
Well, I saw your panel yesterday, you moderated, can Bitcoin reach 1 billion people? So I'm going to throw that question to you. Can Bitcoin reach 1 billion people?
I think it can, especially with all the scaling methods, right? So there's Lightning, there's other scaling methods, and then some people use it custodially, right? So everyone kind of uses what specifically they're looking for with it. But I think the way it's designed, like any other financial system, it goes up in layers. And so each layer kind of preserves exactly what you want it to do. So there's like a settlement layer, then there's fast transaction layers, and then you can have things like more expressive layers, right? There's all sorts of things you can do with it. And so I think long run, there's no fundamental issue with scaling, although there are just hard programming challenges, and then also just, the cultural adoption as it grows.
You were one of the people that was kind of predicting volatility in choppy waters, especially when it comes to Bitcoin's price this year. Can you tell me a little bit about what you think of this recent sell-off and whether you think it's going to potentially go even lower?
So basically, historically, and the sample size is not big because we're talking about a 13-year-old asset, it doesn't do well in economic decelerating environments. And I had questions like, okay, would that pattern hold this time? Or because there's higher inflation, it's the first time you've gone through a down cycle that's inflationary in Bitcoin's history. And I was like, that's a new variable. So I was like, it's probably not going to be great for price, but we'll see. And so far, it has been, pretty bad for price, obviously. And I started to get concerned when I saw Luna Terra buying the Bitcoin. I was like, now I can envision a capitulation event forming. So I actually wrote about that. And so that kind of played out, unfortunately, as expected. It's kind of earlier than I thought. So I don't really have a high conviction if we're going lower or not. It's, it's not like Bitcoin necessarily bottoms as soon as the economic indicators bottom. It's not that correlated, right? So it could bottom ahead of time, it could not. I think we're already in kind of a value range, but that doesn't mean we can't go lower.
Can you tell people what you think the big takeaway is from the Luna Terra meltdown?
One, that there are a lot of Ponzi schemes in the space, that basically there are things that are just based on first in, first out, that are just unsustainable. And a lot of projects are just based on these kind of artificial temporary incentives. So, you put kind of funds into a protocol that lets you pay out higher than market yields, but only lasts a temporary period of time. So it's kind of like bootstrapping. And that only works if you have actually a good product. Like if I have some sort of say protein bar and it's new and it's great and I'm trying to sell it, I might do marketing to, have it reach critical mass, but then it has to become profitable and self-sustaining on its own. It has to actually be a good product. Whereas if I'm just trying to sell like air, if I'm trying to sell fraud, after my initial marketing runs out, there's nothing there. And that's what a lot of things look like in the crypto space. And I think people have to be very careful about what they go into, especially outside of Bitcoin. And I saw a lot of people say it. I think it's the best way to describe it. If you don't know where the source of yield is, you're the source of the yield. You're the exit liquidity if you can't find who else is.
I think this has sparked more conversation surrounding stablecoins, and certainly we might have some regulations sooner as the result of the Luna Terra situation. But can you offer your perspective on stablecoins? Because we've been hearing panels that talk about how in the developing world, people need access to the dollar, and stablecoins really have been the answer. So what are your thoughts on stablecoins? And specifically, Luna was an algorithmic stablecoin. So is there any difference in terms of whether you think one or the other is better?
But yeah, there's a major difference. Algorithmic stablecoins have been fraught with failure. This is not the first one that blew up. This is the biggest one, but there's been multiple blowups for algorithmic stablecoins. So it's just inherently an unstable design. Whereas fiat collateralized stablecoins, they have risks. I mean, they're centralized. You have to trust them and their accounting firm are auditing it properly. But for a lot of people, if you're in say Lebanon or Argentina, if you store dollars in the bank, they can be forcibly converted into local currency, so you can lose your protection there. So in many cases, trusting an outside and for them an international organization to kind of custody their dollars is preferable to trusting a local custodian. And so for whatever risk that might have, they perceive it, I think in many cases rightly, as less risk than domestic banks for dollar holdings. And so, and then especially for people who, you don't have a ton of excess savings, you can't withstand, 30% volatility, 50% volatility on your asset. So a lot of them at the current time, the way the market's structured, need dollars.
Yeah.
So that's why it's outside of Bitcoin, it's one of the few areas that I've been bullish on is the proliferation of stablecoins, because a lot of them are just used for trading, which I'm not, I don't think that's a very sustainable market overall. But then the actual payments, there's a decent amount of activity there. And so, it's got downsides, but I think it's an important part of the market.
Can you simplify what Taro is? Because that'll essentially enable stablecoins on top of Bitcoin, right? Yeah,
so the funny thing is Tether started on top of Bitcoin on Omni, and eventually it migrated onto other things that were more suitable for it. Taro is a protocol proposed by Lightning Labs that's based on the Taproot soft fork that allows them to put assets on Bitcoin and Lightning. And so if that's successful, the most obvious use case is stablecoins, because in theory the Lightning Network is one of the best places to have stablecoins because it's so fast and cheap compared to even the altcoin undecentralized networks. This one, it runs on Bitcoin base layer, but then you get the speed that's rivals any of the altcoins out there. And so I think that's, all else being equal, I'd rather see stablecoins on Bitcoin than elsewhere.
For sure. The Luna situation, I think, it prompted questions about Tether and whether there was going to be a run on the bank with Tether. But some people said that, essentially the network has shown resiliency because people were trying to cash out and they were able to. So any thoughts on Tether?
Well, that shows the difference between a fiat collateralized stablecoin and an algorithmic one. And so I've not been raising warnings about Tether the same way I was raising warnings about Terra. I think that there are still challenges about collateralization, for Tether, because you can think of a stablecoin as being one of two models. If your assets and your liabilities are like identical, at the same amount, then your assets better be risk-free, because if you lose any percentage of them, you're now underwater. On the other hand, you can have more like a bank model where you can take some risk with your assets, but then you better have a capital buffer. Like your assets should be bigger than your liability, so even if you lose a percentage of them, you don't go below your liabilities. And so we see a lot with like USDC, they shifted over to be 100% cash and T-bills, and Tether's kind of moving in that direction, but right now they still have that mix of other collateral, but then we don't know if they have a capital buffer. And so, personally I would rate Tether below USDC in terms of, say, the assurances that it's a, perfectly one-on-one pegged in all conditions. But I don't have the same kind of total systemic concerns about it the same way that I did with Terra Luna.
What do you think should happen when one of these essentially experiments within crypto fails and people literally lose their life savings?
Well, I think there's a difference between an experiment and something that actively preys on people. I mean, I was talking to someone here from Argentina, and they were saying a lot of Argentinians that don't have a lot of money got caught up in this, right? So they saw 20% yields, and they're like, and not everybody's financially literate. And then there's a trap. I mean, in a lot of markets, because of high inflation, 20% yields are not uncommon.
Right.
Even, of course, 20% yields on dollars should raise some red flags. And so a lot of people just didn't know the difference, and they bought into it. And it's because it was marketed as a stable coin. It was marketed as something that's not speculative, even though anyone who actually understands the technical details understood the risk.
Right.
But not a lot of people can be expected to. So I think there's a difference between saying, here's a proposal, here's some cool ideas, versus actively pulling people in with purposely artificial yields that are VC funded to try to make it as big as possible. That's different than just an experiment. So I think that has more legal implications because you're preying on people.
Well, I think that a lot of people are looking for that yield because of the situation we're in, because inflation is so high and people are feeling left behind and squeezed in every direction. So let's talk a little bit more about the market sell-off and the bigger macro picture, because your main newsletter focused on the Fed sort of being in this position of trying to tighten because they really need to, but trying not to spark a recession.
Yes.
So can you talk a little bit about what you're seeing right now and where you think this is going to go and maybe how it's going to play out in 3 to 6 months?
So historically, the Fed tries to tighten when inflation's running above their targets and when the economy is doing pretty well. And then if the economy is weak and it's disinflationary, them and then also the fiscal authorities can collectively print money and basically reinflate things and ease monetary conditions. And the challenge to that model is when you have stagflation, which is you have high inflation, but also you have economic indicators weakening. Not the main ones like unemployment yet, because those operate on a lag, but kind of the leading indicators are already weakening. So this is actually a point where they would normally kind of already have been tightening and have now maybe would stop tightening, and they're just starting to tighten.
Yeah.
And if you look back in history, kind of these gigantic regime changes in policy happen when you have inflation, but then due to so much debt in the system, you can't tighten as much as you'd want to, that you maybe need to. And so I think ultimately that's what's going to happen, that they're going to try to tighten until something doesn't work out, something breaks in markets, or we enter a persistent recession, and they're forced to maybe stop tightening even when inflation's still hot. And I think that's kind of the quote-unquote end game of this kind of structural cycle where they're just unable to tighten despite high inflation.
So I've heard you say that before, and some other macro analysts as well, that idea of something breaking in the system. Can you kind of define what that means or offer an example? Like, what would break?
So 2 examples. One was late 2018 when we had that market sell-off with the Fed tightening. They were talking about being on autopilot. And then there's the famous Powell pivot where they stopped tightening. And that a lot of people thought it's because of the S&P 500 being down 20%, but really it's because credit markets froze. So no junk bonds were issued for 6 weeks in the United States. The whole market just froze. And that's a more serious problem than just stocks being down 20%. And so that kind of forced them to stop because it was basically the market became illiquid. And so they had to stop. And then less than a year later, in kind of autumn 2019, they had the repo rate spike. So they were still trying, they stopped raising rates. They were already cutting rates by that point, but they were still trying to tighten their balance sheet. They were shrinking their balance sheet, and they had to suddenly reverse course into quantitative easing because basically the banking system ran out of just excess liquidity. And so repo rates spiked. They had to come in and reliquify it, and that's an example of something breaking. So generally that refers to either a recession forming, or if it's financial markets specifically, it's credit markets, treasury markets, interbank lending markets, something like that just stops functioning and runs into a liquidity problem and seizes up. And then they're forced to basically reliquify it, even though inflation might be hotter than their target.